Welcome back. It is Thursday. So YieldMax has announced all the distributions for the weekly Group 1 and Group 2 ETFs. Just to recap, reactions to the distributions, and then just pick a couple of names to look at that I found were interesting doing my quick scan. But overall, looking at the YieldMax ETFs, with kind of the market decline lately, as well as some people's just dissatisfaction with some of the payouts, some of the funds have fallen. It's fallen somewhat greatly. Misty down to almost 2.8 billion fund size. It was almost up to 6 at one point. And then Ulti's down to 2.3. That one's been performing considerably not well, or the deterioration in the performance on that one has been noticeable. Then Nvidia, that one's, I think, staying somewhat relevant. I of course, got a tracker for all these on their individual tabs. But yeah, the main ones I've not noticed are Misty and Ulti, of course, coming down. And then here's all the ones that are less than or equal to 100 million. Nothing big to point out here. Just if you want to track, maybe when things jump to the over 100 million in market cap, they do jump up to this tab. So those are the main things I noticed. Going to the ones that are Group 1. So these ones are announced Tuesday. Payment should be tonight, actually, I guess for most people. Look at the current distributions. So we take the current distributions, which are performed in, maybe I should zoom in and make sure this can be seen. This tab right here, recent dividends. From a quantitative perspective, just the largest number, LFGY was the largest. Although from a percentage basis, which takes into account what we're paying for the ETF, FEAT was actually the largest this week at 1.73%. Ulti was 1.68%. LFGY was close at 1.62%. Ymax 1.5%. And then everything else under 1.5%, with only FIVI and Salty being above 1%. Some separation between YMAG and YMAX. YMAX, of course, is 1.5%. YMAG is only 0.87%. Yeah, Chippy, that's the one I've been looking at that's been a pretty good performer in this group. 46 cents, or only 0.79% for the week. Although if we go to the total return since inception metrics, of course, I always say it's not an apples comparison because this goes from the date of inception till now. Some funds have been around longer than others, but in some cases, that's hurt some funds, as we'll see here. But assuming no reinvestment, best fund's been YMAG, followed by Chippy and Ymax. Those have by far been the three best ones. GPTY is also not bad, close to that 20%. Some of the ones that are bad, Ulti, FIVI, FEAT, Salty, are all losing on the investment, assuming no reinvestment dividends. These bar charts over here kind of show magnitudes of how they are doing. If you go based on reinvested dividends, you get a slightly different picture. YMAG, the performance of YMAG over Chippy extends because we've had that longer period for dividend reinvestment compounding to take place. But even with reinvested dividends, you can see Ulti is still positive in this case, but the other three are still negative. And then let's see, I also got, now that these pay weekly, of course, I do like to track how much they've paid monthly, so we can see the total return time frame on 1 month. It is in that tab, and these are on the percentage basis. So you see Chippy from a total return perspective has been the best for the month at 6.83%, Ulti down during that time frame. And so I got the total return 1 month, the total return 3 months, 6 months, and 1 year. Go out to 3 months. Once again, we can see Chippy has been the leader, followed by LFGY, both over 13%. Ulti negative. So I guess that's the thing I've been seeing. Ulti was a very popular fund. Lately has not had the best of times. The distributions maintained a pretty good rate, but the ETF price has been falling somewhat dramatically. If I want to look at Ulti specifically, this will just be the one I'll look at in this Group 1 here. You can see the distributions for a large part. If you only look at the last 13 or so distributions here, they were hanging around that 9 barrier. Then they fell to 8, and then boom, they're always down to 7. I guess 7.9 cents, close to 8. But there has been some deterioration here, of course. You can see in terms of the distribution, they kept it around 9 for as long as they could, and then all of a sudden it's starting to fall off a little bit. But then from a total return perspective, though, the last 3 payments, you can see the Ulti price. So this is over the last 13 weeks, gone from 560 down to 470. That said, the total return is about the same because the cumulative distributions went from 1392 up to 15. So as the ETF price shrunk, the cumulative distribution rose. And if you add these two bars together, 13.9 plus 5.6, you get about 19.5. And this one, you got about 19.7. So you can see over 13 months, we're about even money here on Ulti. or I said 13 months, I meant 13 weeks. If we extend that out a little bit, go out to about 21 weeks, yeah, it's just a flat investment. Basically, all the money you're paid out in distributions, basically the ETF price has declined by. And a flat investment, for those who just look at the ETF, it looked like a very bad investment. But I guess we're pretty flat there. In terms of what they're holding right now, we got an updated thing. Here's the stocks they're holding. And of course, Ulti employs a method where they buy the stock. Or maybe I'll get to that later. They do invest in individual stocks, no synthetic positions, like some of the individual ETFs, individual stock ETFs that Ymax offers. We got SMR, Hood, RKLB, Coin, and CoreWeave being their top 5 positions. They got a total of, what we think here, about 15, 20 positions total. Got some Affirm and SoFi here at the bottom. But for the most part, as you can see, very volatile names. Usually dealing with AI, stuff that powers AI, quantum computing, and quantum computing again, and then crypto, of course. And then the financial apps. And those are basically the stocks that Ulti is holding. All of these, of course, high in implied volatility. They got a little bit of cash, nothing too big to look at. Here's the one I wanted to look at here. This is basically how they're structured. They basically buy shares. So here I take the number of shares divided by 100 to give them their contract collateral. So for every 100 shares, you can sell 1 call contract. So if you've got 1,000 shares, you can sell 10 call contracts. That's why I divided by 100. So in this case, you can see they got 7,499 contract collateral for a firm. And they use that to sell the call. Firm's currently trading at about 70.20. They have the call sold at 74. So they took an option premium for that. But then they use some of the option premium to buy puts. So you can see here, they got 2 different strike prices. They got about half the position at 63 puts. 63 strike price puts and half the position at 65 strike price puts. And you can see that general pattern is basically for all of these. There are some of them like Galaxy here. So this one, they bought puts at 29 and sold puts at 30. So basically they're doing a put spread that they sell. So since they're selling the 30 strike, it means if Galaxy goes under 30, they will be assigned the stock at 30. So at 29.50, for example. But they also bought the stocks at 29. So if the stock went to 27, they'd be assigned at 30, but they want to assign it to somebody else at 29. For that right, they're basically taking a little bit of premium, and I guess overall they just hope that Galaxy stays above 30, which I'm taking a look at it right now, and it's about right at $30.40. So that's their strategy, I guess, on most of these. This is a few, or rarely what they do. Usually they have the stock. You can see for him, here's another example. A little different because they have the stock. They have enough stock for 21,000 contract collateral. They're selling calls and all that, but they're selling them at different strike prices. They're selling, let me just or I guess I got the stock. If you hover over it, it says strike price for the actual stock. That's just what the stock price is, or recent price. It's $42.64. They got calls sold at $49.50, $48.50, and $48. So all pretty far from where the price is right now. I'm guessing that's because him stock's probably down for the week. We do see they got puts bought at 42 and 43. So at least the 43 puts, it looks like they might execute those. I'm looking at the stock price right now. That must have been earlier today. It is 41.20. So actually both these puts are in the money right now. Mainly because him's and her stock, looks like for the week, it's definitely down. It's in the 45 area, between 45 and 47.50, and recently it's gone down with a 5% decline today. So that's where that's where their put protection comes in. They use some of their call collateral to buy puts. So I guess it's an interesting strategy. They tend to do this all over the place. And if you want to just see it for each one, it's a lot of data. I kind of just put it all in one thing. Or you can click which individual equity you want to look at. I got them in terms of how many contracts they have. I also have it in terms of market value. So as you can have a lot of contracts, but if they're far away from the strike price, their market value is not worth that much. So this kind of just shows those magnitudes. Whereas if the contract price is really close, or if the strike price is really close to the stock price, the market value there tends to be more, and it goes even higher if the contracts go to in the money. So someone can track that as well. Here, we just see that if we take a look at the Affirm price right now, I think that one reported earnings not too long ago, or it looks like it just did, up quite a bit after earnings. Calls are worth more than the puts in this case. Maybe that one isn't a good one because they just reported earnings today. But yeah, you can go through and look at these if there's any particular stock you're interested in. If you go to MP, for example, which is MP Materials, you can see the calls are almost worth nothing. It's because I look at MP, okay, it's $51 and change. See the calls they sold at 65 and 61. So the stock that's down 5% today, these calls that they sold, since the price is far away from the strike price, those are not worth very much. Whereas the put at 53 is worth quite a bit, and it's probably worth even more as we had a down day today. So if I run this tomorrow, I'd expect to see these call parameters to shrink even more and this put market value to increase. When the put market value increases, of course, YieldMax captures that, but in an indirect way because the stock shares that they own go down in value, whereas the put goes up. So I guess it cancels out, but it does limit the downside that they would have if they were just investing in the equity alone. But yeah, that's Ulti. Maybe we'll see that one start doing a little better in the future, but definitely hasn't been a good player right now. As for the group 2, really just want to point out which ones are paying a good percent return, and I want to take a look at Facebook and Nvidia. So if we look at this is all of them, and what I'm doing is taking the dividend that was announced divided by the recent price of the ETF. I guess SMCY, you can see was trading in the $12 range. That one has fallen somewhat dramatically. It was somewhat surprised as well. I think that one started at 50 and it's all the way down to 12. So I guess I myself did not know that was down that much, but I'm trying to pull up a chart to see where that decline occurred at. But with the recent dividend divided by the recent price, even though it has fallen quite a bit, it's 2.74%. So yeah, it looks like in late August, I guess it fell down to the teens. And then, yeah, I guess it's been a slow drag all the way down. Although as of October 18th, it was 17. And then from then, October 18th till now, it's had a pretty good drop all the way to, it looks like it's $11 and change now. But from a percentage basis, that's not always a good thing, I guess, if the ETF price is dropping. But that one was the best, followed by Palantir at 2%. The NVDY was actually pretty good at 2%. Maro, Hui, AMZY, Google, all kind of right around that 2% barrier. Then Tesla goes down to 1.75%, Misty at 1.7%, Snowy 1.67%, Coney 1.55%, and everything else was under 1.5%. That is for the week, so not terrible to be under that barrier. The ones at the very bottom were XOMO at 0.45%, Microsoft, Disney, ABY, and Apple. As far as the magnitude, you can see these bars here represent a relative amount compared to one another. From a total return perspective, even with the decline in Misty lately, it's down to 10 now, or it might even be below 10. But the total return is still pretty good just because the cumulative dividends paid out. It's been good enough to, I guess, mask that. Yeah, Misty is at $9.54. So with the decline in Bitcoin and the kind of the leverage decline in MicroStrategy or strategy, Misty has not received that well. Although the cumulative dividend has paid enough that I'll never see this total return percentage go down too much just because it's already paid out such a massive cumulative dividend already. But NVDY is next, followed by PLTY, Hui, and Coney, all at the 90%. And this is since inception date or higher. I noticed AMZY has been coming in strong lately. So is Google from a payout and a total return perspective. But the ones I wanted to touch, I'll start with NVDY. We see that the recent dividend was 32 cents. I was thinking something like that would happen because NVDY did build up a pretty substantial synthetic value. I just wanted to confirm that with the charts here. So if we go to Nvidia in depth, of course, we'll see what their current holdings are. So I guess as of this morning, which markets moved quite a bit today. So these black lines that are estimated values as of this morning, I see like Nvidia, for example, down, it's actually at 188 with the decline today. So the black line should probably be closer to here. But here's where their calls were set up. They're, of course, doing credit spreads. They've started selling the 1114 contract, but they got basically 1114 and 117 expiration dates. And they got calls at 207.50 and 210. So right now, those, of course, look like they may expire worthless. From a fund makeup perspective, you do see that synthetic is lower. It's actually negative now, which is somewhat surprising. It built it up quite a bit, and now it's negative. Synthetic usage, they've sold some of them. They still got a decent amount. They'll probably sell. They either sold today or they'll sell tomorrow. But the thing I wanted to point out, if you go to the chart that tracks their cash, the ETF value, what their weekly contracts they sell, as well as their synthetic value, If we select everything, we just go to the end. So you can see here, they paid a pretty good distribution. We probably won't see that yet until it goes ex-dividend date. They paid, I almost forgot already, like almost 30 cents. Looks like it was 31 cents, 31.86 cents, maybe is the way to say it. But you can see here, their synthetics negative, but their cash positioning was $14.25 a share. And now it's all the way up to $16.36 a share. Where did that come from? You can see their synthetic had a value all the way up to almost $3 at this low point. And then it looks like they sold some of it, or basically what they did is they took the synthetic strike price up and took in some cash. So you had the cash buffer go up. And then they did it again to get their cash up. So I'm guessing when they announced that 31-cent distribution, it wasn't all from the weekly contracts they sold, but rather it's going to be like a mix. Some of the money comes from the weekly contracts they sold, whereas some of it will probably come from the synthetic that was cashed out. But their cash position is actually looking pretty good, at least relative to where it was. That, of course, was built on the back of the synthetic. So all Ymax owners do like to see that underlying equity go higher. Build your synthetic, which then you can cash in and basically increase your cash, at least from the fund level. But that's Nvidia. And I think the other one I want to touch base on was Facebook. Facebook, not much to say other than it was noted that their distribution was 1 cent. Although if you go to their website, last I recall, it was like 13 cents. I believe 13 cents is the actual amount. We'll be able to see once it goes ex-dividend date. How will we see? You can go to this chart which tracks their cash positioning, and you'll be able to see the distribution actually hit their cash positioning. So you'll be able to see it drop by what the dividend amount or the distribution amount actually is. So I guess we'll see, but I guess it was 13 cents. I think that's what my charts show. So we'll go with that value for now, but we'll see when that comes. Meta is currently trading at, I guess, 16.618. So you can see the contracts they have sold are all at 640 or higher. So all these contracts are basically worthless at the moment. The funds, of course, get to keep the premium, but their synthetic values are all declining at the moment with the market downturns. But anyway, yeah, I guess that's a quick update. And I guess my reaction to the YieldMax distributions. We'll see how these adjust going into the future.